Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Welcome to our show that's for you and about you, those who work so stinking hard for your money, and you want your money to start working harder for you right now. You want that freedom, cash flow, and prosperity today, not 30 or 40 years from now, but right now, to live that life that you love, doing what you love with those that you love. But most importantly, guys, it's not about being rich. It's about living a rich life, because as you're blessed financially, you can create a greater impact in the life of others. Thank you for allowing me to create that impact in your lives. Thank you for tuning in, binging, sharing, doing all the things that you guys have done. Now pushing us into our 8th season. So, man, what a blessing it's been. And you guys have made that possible. So thank you so much. As a quick reminder, be sure to go to our YouTube channel and subscribe today. The Money Ripples with Chris Miles page, where we got some other bonus shorts and videos that are on there for you. And remember, on moneyripples.com, there's that calculator, that passive income calculator, that you can go and find out how much passive income you can create within the next year. So go check that out.
Chris Miles was able to retire twice by the time he was 39 years old. But he's not content to just enjoy his own financial freedom and peace of mind. Chris wants you to have your own ripple effect so you can live free today. He's not the financial advisor you expected. He's the anti-financial advisor you deserve. He's jumping behind the mic right now, ready to make waves. Here's Chris Miles.
All right, guys. So I've got a special guest here that I'm bringing on that, it's very unique with what we do. And I know a lot of you guys have heard me talk about infinite banking and using that and how we can double dip, where you can make money in 2 places at the same time, right? We talk about that arbitrage, how we can borrow from those policies, be able to go and turn around and invest that in real estate or whatever kind of investments that we want to do, right? The cool thing is that you have options. You have a lot more options, because most of the time people just tell you about borrowing from the insurance company. But did you know that you can actually borrow from banks at a cheaper interest rate, making a higher return? So that's what we're going to talk about today. So my special guest here that we have is Brenda Newton. Now, Brenda works with Bank Corp. That's how I met her. One of the people that we refer to people to, if you want to get a really low interest rate right now on your money, it's pretty incredible. She has a huge, extensive background in the financial services. She returned to private wealth and private banking after spending years in management with Smith Barney in California. She actually lives out in the Kansas City area now, has her own offices, now works as part of the institutional banking division with Bank Corp, which is who she represents, and does a lot of things with lending, and has been doing this as a big part of her practice over the last decade. So Brenda, welcome to our show.
Thank you so much. I appreciate you having me this morning. Congratulations on 8 seasons.
I know.
Yeah, absolutely right about ways to leverage the life insurance and not have to go through the policy loan process, have something that's available to your clients for a long-term basis, something that's revolving that they can use and repay and redraw. Makes it super easy. And that's our product. And that's my focus here with Bank Corp, is on insurance-backed lending. And that's what we do.
Yeah. So for those that are tuning in, maybe you haven't heard this before, right? When you save money in life insurance, you can save the money basically tax-free. It's like a tax-free supercharged savings account. You get paid much better than the bank, and it's tax-free. But the thing that really makes this cool, because it's nice, it's certain, it's secure, right? We all know that life insurance is great. But what's amazing is that you can actually get lines of credit against it. In most cases, we use the insurance company that does it. They give you the money from one hand. They'll charge you 5, 6, or as Brenda and I were just talking about with one of our clients, 8% a year on lending that money. Now that strategy can still work, right? But just remember that, at the same time you're borrowing, paying the interest, the insurance company is also paying you interest. What's nice though, and this is what I want you to address, Brenda, is that I know with companies like yours, with Bank Corp, you guys can lend at a much better rate based on prime rate right now, which is dirt cheap, low right now. You can loan that money and save people thousands of dollars a year. In fact, I know some of my clients, we already have been saving them, somewhere in the ballpark. If they borrow 800,000, that saves them 16,000 a year by using you versus using the insurance company. So let's talk about that a little bit and how that works with you guys.
Yeah, the way that it works with us, and we refinance a lot of policy loans across the country, is our pricing is tiered. It's based on the commitment level. So it doesn't matter if they use the line or it's just put in place as an emergency safety net.
Just an open line of credit, right?
Just an open line of credit.
Yeah.
And we are operating right now off of our floor interest rates. because when prime went to 3.25, our floor rate is 3%, and all of our actual pricing is below that. So 3% is what we're currently at, and that's for anything from $65,000 to an unlimited dollar amount. One of the benefits that we offer is we don't require a policy to be seasoned or have been with the carrier for more than 12 months. As long as there is sufficient cash value and comparable loan available from the carrier themselves, then we'll go ahead and set that line of credit up for the client.
That's big.
Thus, it's a super easy process, as you know. It is quick application done with electronic signatures. Clients have a chance to review our loan agreement up front. It's not something that they get at closing that then they have to read. It's a really streamlined process, and with us, it is credit scored. So it's something that we have, it's a minimum credit score of 660 that we use, which is a fairly low number.
Yeah.
We also don't report them to the bureaus, which is a great benefit, especially for a lot of your business owner clients, that could really impact.
Yeah. I think that's one of the best things, I think, is the fact that it doesn't show up in your credit report, because it is just a secured line of credit, but that's not the case with every carrier. Every carrier or lender is that sometimes they will report it to credit, and that's big. And I want people to understand just how powerful this is. When she says 3%, right? And also the fact that it's less than 12 months. I have several clients, even like dentists, who might put in over 50, 100,000 a year in that first year. They'll have 60, 70, 80,000 sitting in cash, and they can turn right over to you versus having to use an insurance company right away, right? The thing that's, I think, amazing is that, guys, if you understand how the bank works, this is doing the exact same strategy that the bank uses on you. Because when a bank turns, it's funny because we're kind of reversing it. You are a bank, but we are kind of reversing it back to you guys, because, banks, when they borrow from you, they borrow from a savings account, right? That's why they pay you that nothing percent. They borrow from you and then turn around and they make money with it. Even a CD, they might pay you 1-2% if you're lucky on that CD, but they know they can go and do a car loan at 3 or 4%. And you might think 1 or 2% doesn't mean much, but here's what's important is that it's not the 1 or 2% difference. It's the actual rate of return on that interest. Because say that, for example, you borrow money at 1%, but you earn 2%. That's not a 1% return. That's a 100% return, because you made double the money. So same thing with what Brenda's talking about here. She lends it to you at 3% and say that the insurance company pays you 6%. Right there, guys, you made 100% rate of return on that money that you're now also using to invest in real estate or wherever you might be, adding massive returns to your money. I mean, that's just incredible.
It works really well, especially for your real estate clients. We have a lot of clients that are investors or are flippers, and we do allow clients, as long as there's room on the line, they can capitalize interest. So they may draw against the line, and then they're not making any payments. It's the interest is being tacked on to the line balance, and then they sell that property, or once it becomes leased up or whatever they're doing, then they start paying that down. We're very flexible in that way. As long as there's room, they can continue to do that. In some situations, because it's not always real estate, we do these for a million different reasons, but clients often do want to just pay annually, or maybe they don't want to pay until they get their quarterly bonus or something like that. And it's very flexible. As long as they're capitalizing, doesn't prevent them from making a payment, so they can pay down anytime they want, whether it's just an interest amount or they pay the line balance down and then they're revolving it again for the next deal.
That's big too. I'm glad you brought that up, because I think about a lot of the real estate clients we have, and this works for business owners too, but with the real estate clients we have that are actively flipping properties or they're renovating properties, many cases, they go out and they borrow money, hard money, right? Short-term lending that they're getting from hard money lenders, and they will easily pay at least 1 or 2% up front, plus they're paying at least 10, 15, 16, 20% a year. So if that's a 6-month deal, they could easily be paying at least 8% out of pocket, where with yours at 3% over 6 months, it's really 1.5% total that they would pay. They would save so much more money than trying to seek out hard money from somebody else. And speaking of, how easy is it to get access to this money through you guys?
So we offer 3 ways for clients to get access. They can wire transfer, which is an online DocuSign request. So that's easy. Wires are done same day and there's no cost for domestics. We provide a checkbook if they want one. And then also through our online access, and we have a mobile app, clients can link outside bank accounts. They can link up to 3, and they can facilitate transfers back and forth between those accounts and the online access.
That's huge. And when they do that kind of that transfer, how long does it take for it to show up in their account from the time they request it?
Normally it's next day.
Wow.
So depending on time of day and ACH is processed, it'll credit their bank account the following day.
That reason alone is huge too, because I know with a lot of my clients, when they say, okay, I want to do a loan request, because a lot of insurance companies haven't quite caught up to the 21st century. You know, they're still doing things by paper, snail mail, right? So they either mail you a check or they do try to do the EFT, right? They try to electronically send it to you, but that could still, process time could take a week, week and a half before you get the money. Where here, especially if it's a quick, like, oh, I have an opportunity, I got to get the money wired in 3 business days. You can do that quickly through you guys very easily.
Right. And they can wire, when we send a wire domestically, it's received the same day that the client sends it. And having a checkbook is handy, because you never know. It could be on a weekend, they find a new car they want to purchase. They know they're going to use the line. They can just stroke a check and hand it off.
Yep. And again, no minimum monthly payments. That you just get charged interest like a student loan and deferral, right?
Correct. Interest only monthly is due, and they have an option of paying it, or they can add it to the line.
Yeah.
And there's no fee. We don't charge an origination fee. There's no ongoing maintenance fees. One of the unique things, we don't charge a non-use fee either. So clients who may put this into place for a short-term need, they can, once it's paid off, they could leave that for whatever amount of time that they want. And we make increasing it easy too. So that's always something that clients like. We require just an email request. After the first 6 months with us, they can increase twice a year. And I have clients that ask a lot of times, well, why doesn't it just move up as my value moves up if I'm making monthly premiums? And that is because we don't get that automated feed. Insurance companies don't provide that to us. So it being a manual process, you know, twice a year usually works for most people. They're making annual premiums. So very easy.
And that's almost, I would say 99% of my clients are making annual premiums because it saves them so much more money to do it in that way. And like you said, you don't have to do it once a year if you want to re-up that again. And is it a pretty hard process to get that done, to get it reapproved?
No, increased, you mean?
Yeah, to increase the line of credit.
No, it's just an email request, and then it takes us about 4 or 5 days to process.
Wow, perfect. So this sounds almost too good to be true. What's the catch?
And we hear that a lot. I've heard that a lot for the last 12 or 13 years I've been doing this. Honestly, there's no catch. I guess one of the reasons we look at also the amount that's available from the carrier themselves as a policy loan, and we compare that, is because we never want to implode someone's life insurance. Surrendering a policy is the very last thing. Yeah. Should there be a default, which is really hard to do with this type of lending, but should there be a default and we have to collect, we'll just push it back to the carrier as a policy loan. And then they have a policy loan again. Yeah. Because, you know, we don't want to create a taxable event. We don't want to, like I said, implode someone's life insurance. So that's sort of our out with these. And honestly, we've not had to do it. So yeah,
that's always good. Well, and I think that's a good perspective from the bank's perspective. Like, why do they like lending to life insurance, even if it's so cheap, such low interest? Why is it that they like life insurance?
It's cash. So it's cash secured lending, which requires a smaller amount of capital that we have to put aside for that type of lending. It's also with carriers. We do currently lend to 8 now carriers, but it's with carriers that are highly rated. And some of those have more capital themselves than many large banks.
Right.
So it's probably the safest, one of the safest outside of cash in the bank lending that can be done.
Yeah. Well, and that's the thing I keep reminding people. I said, you know, with insurance companies, the nice thing is even if they go defunct, that's the real risk, really, because if you're doing whole life, your cash value should not ever decline, right? Universal life, that might happen, but not with whole life. But with banks, you know, yeah, they have FDIC, but FDIC doesn't have that much reserves if there's a real big catastrophic recession or depression, where with life insurance companies, we have reinsurance backing up those companies to make sure that they stay solvent, right? So that's a good point to bring up about that cash being certain too. Now, speaking of like different types of policies, and we've talked about this even off the air as well, with universal life versus whole life, is it different?
It is different. And we only loan right now against whole life.
Why is that?
And the reason being universal life, the cost of insurance, can adjust. What the clients are paying can adjust. There's more fluctuation in the cash value. There's more risk to the bank at our advance rate of 95%. So we are reviewing all of those UL suite of products, and we expect that to be added to something we can do next year. We're just trying to determine what the parameters are going to be for accepting it. And that takes some time. Any bank adding a new product, it's not just something we magically say, okay, we're going to do. It has to go through a risk review, through our board approval, has to get past legal counsel. There's a lot to do. So it will be several months down the road before that's coming.
But IULs, you can't lose money, right? And they're the hot thing right now. They're guaranteed,
Yeah, well, if it's March of 2020 and it credits 0 and the market is down and your gap collateral's held in the market for a premium finance deal, you might have got a pretty big capital call that month.
That's right. Exactly. That's a big point I try to bring up to clients. It's like, yes, it sounds sexy because you can get potential, market returns within limits, but just know that that cash value is not guaranteed. Even if they say there's a bottom at 0 or 1%, plus increasing insurance costs could actually start eating that cash value, which is actually what we're seeing with one of our clients I referred to you, was that very situation. It was like, oh, it's actually starting to eat in the cash value. That's not good.
It can happen. I would say it probably doesn't too often, but it can.
It can.
And it's a risk. That's one of the reasons it's taking us some time to review and figure out, because there really aren't any other lenders out there that are loaning in that space. So we will probably be the first.
It could be a niche. Yeah.
It could be a niche for us on existing. I mean, it is what they take all the time for premium finance. When they're doing those type of deals, almost all of those are IUL.
Yeah.
But they're structured differently. There's a lot more underwriting. There are a lot of other things that go into that.
Yep. So like you said, if somebody has at least 50, 65,000, right?
They need to have at least 68,500 in cash value. That with our advance rate, that's total. And they can combine policies, probably something I should mention.
Yeah.
They can combine policies, they can combine carriers. So if husband and wife each own policies, those can get put into one line. Business partners, family members that have a specific purpose they're needing it for. We can combine those. We can also combine if they've got Penn and Guardian and Mass, and we can combine carriers also.
Perfect. Yeah, that's exactly what I wanted to know. So guys, if you got
I'm sorry, I didn't mean to talk over you. The minimum per policy is cash value of about 5,300. And that gets us to our minimum commitment amount per policy of 5,000. Now, do we want to look at a deal that's made up of 15 $5,000 policies? No, and we wouldn't. But, if they've added a policy recently for one of the kids and it's maybe at that level and they want to include it, we're happy to do that.
That's perfect. Yeah. I know, especially lately, I have a lot more people coming to me saying, I want to create policies for my kids too, not just for me. But be able to combine all that together makes it really nice and kind of makes it very convenient, especially if they're already owning those policies anyways, as parents.
Yes.
So, well, great. Well, definitely if somebody has at least 68,500 in total cash values between all their policies, what would be the best way for them to reach out to you?
They can either email me, which is bnewton@thebankcorp.com, or they can give me a call at 480-383-3063. It's my cell. I use it for everything.
Great.
So
and of course,
text, email.
It's right there behind you on the wall there. And
oh, it is. Yep.
So but if they can't see it, they're listening, because there's a lot of iTunes listeners too. Right. Then great. Then obviously we'll put in the show notes for you guys so you guys can reach out to her. But I'm telling you guys, 3%. And that's not, by the way, that's not just three. That's prime minus blank, right? Depending on how much they have.
Depending on how much, if it's between 250,000 and $1 million, it's prime minus 1 is
Oof.
the true rate. So,
And that's always a
they would
concern.
have some time with Fed raises, and then $1 million plus is prime minus 1.25.
Wow, that's great. And that's always a concern. A lot of my clients say, well, like, what if the Feds raise their rates? Well, if you're prime minus 1, you're not worrying too much about that as much.
You have a few raises before you see a change. And
Exactly.
if it ever gets to the point that rates increase and the policy loan rate is a better solution, the clients can move that back. They're not locked in with us.
That's right. You can go back and forth wherever the interest rate's better, right?
Exactly.
Exactly. Well, Brenda, this was really valuable. And I know this is going to be a hot topic for a lot of people here, because I know a lot of my clients, I just can't get all of them to read our emails when we say, hey, here's a great contact. So to be able to see this, just fantastic. So again, Brenda, thank you so much for being generous with your time and your knowledge here.
Thank you so much for having me. I appreciate it.
And everybody else, like we said, you got at least 68,000 plus between all your policies. Reach out to Brenda, find a great way to get a line of credit. Even if you've got a loan against your policy, not a problem. You can move that loan over to here, save on the interest, and just get better arbitrage, better returns on your money that you're using. So guys, again, it's not about just listening to these podcasts, about doing something about it. So go and make it a great and prosperous week, and we'll see you later.
Visit us online at moneyripples.com for more resources to help you fix money leaks and get your money working harder for you now.